Hey everybody, this is Kevin, a CPA that does financial planning. Today we're going to talk about annuities, guaranteed income, guaranteed returns. Income is possible, guaranteed, and it's not evil. But annuities, we really feel like they have a defined place in people's wealth, okay? Many economists, by the way, think only the single premium immediate annuities are the way to go, or not to use annuities. If you're going to think that, stocks and bonds are going to give a certain return. But for the rest of us, for most of the human beings, some annuities are okay, especially in certain circumstances. So let me see if here I can get this to go to the next slide. There we go. We do not sell annuities, but we have contracted with insurance companies to get them where appropriate. We may or may not charge a fee, but we absolutely never get paid by an insurance company. If we ever get paid, it's from a client. We are fee-only fiduciary financial planners. So you could actually say that we have a bias against commission products because we don't make commission. But because that's what I see online a lot. People will make write an article or make a video, and they say, well, yeah, you hate the products because you get paid differently. So we get paid differently. You can make that argument. I'd like to talk about the story of an antibiotic that I sold back in the 1990s, late 1990s, early 2000s, called Timentin, and kind of how we probably didn't sell it the best way at the beginning, but then we figured it out. And that's what I think I'm going to try to do here with annuities, is help you figure it out. How can a fiduciary help you frame annuities? Again, no commission, but hopefully we can help you frame annuities. So the story of antibiotics in my early 20s, a drug called Timentin, or Timentin, sometimes in the Bronx it was called Timentin. So SmithKline Beecham had an antibiotic that was really great for hospital infections. We came out with the drug. We were very excited. Augmentin was its sister or brother compound. And Timentin, actually, it covered or killed a lot of different bacteria. It was bactericidal. It killed bacteria. So what do? We went to doctors and hospitals and we said, look, here's how this works. It kills bacteria, kills gram-positives, kills gram-negatives, kills anaerobic bacteria, which are antibiotics that, bacteria that don't take in oxygen, only in the presence of no oxygen. So we told doctors, this is what it does. And guess what? When we first launched the product, it wasn't used a lot. And that's because doctors do not see bacteria. They get reports about what the patient might have after the fact. But what doctors see is they see patients and they see symptoms and signs and symptoms. And so they never saw a need for Timentin because they didn't see all these bacteria. We started to then paint pictures of neutropenic patients in cancer centers, nosocomial pneumonias, aspiration pneumonias, which people aspirate, they have anaerobic bacteria. So anyway, long story short, we started telling doctors the people to use it in. And I think that's the same with annuities. Many times people get really interested in what annuities can do. They can give you a tremendous upside without any downside. They can give you guarantees. They can do this, do that, do this. What we feel like is that there are absolutely places for people to use annuities. Absolutely. Some clients don't need annuities, but there are absolutely places to use annuities. And it's almost like, a physician, where indicated. And indicated just means the appropriate people. So there's lots of confusion around annuities, and I'm going to try to help clear that up a little bit, but I don't know if it can truly be done. Once again, we do not sell any products where we get commissions. We just help clients have good financial plans, we hope. So case study number 1. So this would be clients that have too much cash. Now, you would think that, well, who would have too much cash? Number 1, is there such thing as too much cash? You can never be too much rich. You can never be too rich, too thin, all that kind of stuff. But actually, as a financial planner working with a lot of high-income people, I've noted that multiple people have and they usually will say, I know I have too much cash after we're working together for a while. They don't usually volunteer that up front and say, hey, I know you do investments and you do financial planning. By the way, I got a truckload of cash in the bank. They don't usually tell us that. But what I've found out over the years is many people that are high income, they have their money in their retirement plan. They might even put some money in IRAs and 529s for college savings. And then they don't know what to do with that next dollar. So what ends up happening is it goes in the bank, and the bank just gets bigger and bigger. And again, I know you're thinking, if you don't have this problem, that's a great problem to have. But all people have certain problems, and this is one of the ones that we've seen. So the real concern many times is either, number one, the stock market is too high, or number two, there's a very well-known phenomenon called loss aversion. So how could you have a loss aversion? You have money in the bank. Well, if you end up taking those dollars out of the bank, which you can spend at any moment, and you put them into some investment or some product or give it away or whatever, you lose the ability to purchase stuff. And that is the loss aversion. You see, when I first started, I would say to people, you should do this, you should do this, you should do this. And they had the money to do it, and they wouldn't do any of it. And it was because I finally found out that a lot of people are like, well, if I invest that dollar, if I want to buy something, I can't buy something with it. So this is a very well-known phenomenon. So they're just not sure what to do with the extra cash. And again, this case study, too much cash actually can still make you feel guilty, because then you're saying, I'm not getting much of a return on it. I know I should do something different. But, hey, again, it's a dynamic that we've seen with many people. So the other thing is, when the dollars are taxed, that you have money in the bank, you're kind of guilty about not getting a real high return. Then when you receive those dollars, they get taxed as ordinary income every year. So if you earn $1 and you're in the 24% tax bracket, you pay 24% to the feds. You'll pay money to the state if you're in a state that has an income tax. Come to Tennessee, we don't have one. But so not only are you receiving very little money, it's also getting taxed every year. So here's the annuity solution for people that have too much cash, okay? 3 to 4 times the returns of CDs. I don't know if we call it a return. It's a contractual obligation, but CDs, a year CD, what is a year CD paying? Maybe there's some online banks that might be paying higher than 1%. I don't know. I've not seen that many recently that are paying that high. So you get higher returns, but there's a reason why, and that's because there's an illiquidity premium, which means that you cannot have your money back like you can with CDs. CDs, you put your money in a CD, a week later you say, I want that money back. And they say, well, you're going to break the contract of the CD. And you say, okay, what happens if I do? They say, we still give you all your money back. You just won't get the interest. Well, with annuities, the illiquidity premium is that you hand the money to the insurance company, or it goes to the insurance company. There's a contract that a certain number of years you're not going to use more than 10% of the principal or the corpus. That's the reason why you get a higher return. There is no free lunch here. So I never want people to think there's a free lunch with annuities. We actually have to fight that quite a lot. The other thing about the annuities, and Jason often reminds me, our chief investment officer, that income tax is deferred. So that dollar in the bank gets taxed immediately in that year. Income tax gets deferred, and deferred just means you do pay it later. So if you have a 4-year annuity, when 4 years are up, you can either take the money, pay the tax at that point, or you can roll it over again to another annuity and continue to roll it. That can be an issue. That can be an issue. So it is ordinary income when you do take it out. And if you're less than 59.5, there can be a 10% penalty as well. So again, you just have to really understand what you're getting into with these. Now, we think these will keep up with inflation. There's no guarantee because you sign the contract. What if inflation runs into that 1970s inflation? But you're no longer feeling guilty, at least, about not earning nothing. Okay, that's really the key to client case study number 1. So client case study number 2 is I just don't trust the market. The market is rigged. And you know, a lot of clients we work with, they don't think the market is rigged, or they think the market is rigged, but they still think they're going to get a return. But the stock market, a lot of people like it when it goes up. They don't like it when it doesn't go up. They want to use other assets. They want to get high returns. They still want to be rich or wealthy or whatever the numbers name is. But CDs are only paying 1%. I'm just throwing that out there. Bonds are paying, 30-year U.S. Treasury bonds right now, only 1.5%. Interest rates are really low. You can't make something out of nothing. Inflation is 2.5%. Again, not exact. That's a guess. So if you keep all your money in the bank and 10 years go by and interest rates persist the way they are now, we know every year you will be losing purchasing power. So people that invested in the bank 10 years ago, it wasn't really an investment. Again, it just kind of built up, or they didn't want to invest in stocks because they don't trust the stock market. Well, guess what ends up happening? It becomes a real risky proposition because over the long run, if you don't keep up with inflation, you lose the power to purchase. You put a Benjamin in your mattress, you come back 10 years later, it's still a Benjamin, but a Benjamin ain't worth a Benjamin anymore. That's the problem with inflation. So there's a catch-22. A lot of folks believe that stocks have too much risk, but safe investments don't pay anything. So there's actually an extremely big risk if you don't take any risk. And that's that you'll run out of money in 10 to 20 years because inflation, it'll cost so much to live that you won't be able to stay ahead of inflation. It's a real catch-22. So the annuity solution here is that, especially with equity indexed annuities, that people can feel, I'm going to say feel, like they possibly could get a higher return. Equity indexed annuities we'll get to in a moment. But fixed income annuities, deferred fixed income annuities, you're going to get a guaranteed amount, which is probably going to be higher than the bank. Absolutely not going to be as high as stocks and real estate, and maybe not even as high as certain bonds. But the annuity solution here for not trusting the stock market, if interest rates do go up, by the way, the guaranteed amount of money you'll get will also go up. So one alternative idea here for not trusting the stock market is there are products. You could buy bonds, which is like treasury bonds, U.S. bonds, and then buy options, call options. Very, very hard to do, but there are now some ETFs out there where they do it for you. You have to pay them. There's no free lunch here, but you can still lose some principal, but you won't lose as much if the stock market, or when the stock market crashes, I should say, because it always does, and that's okay if you don't have to sell. So client study number 2, yes, we would really love to help try to educate people on how equities work for the long run. That if you don't look at them, every year, if you can think about decades as opposed to months and years and days, and you diversify broadly, you have a great probability of having some success. We're not guaranteeing it, but you have a probability. If you absolutely do not trust the stock market, we cannot convince you of that. But then the risk of running out of money becomes a huge risk unless you have really rich parents or you marry into wealth. So maybe that's another strategy you can do. So anyway, I'm joking about that. Client number 3, I hate bonds. So there's lots of people, not lots, multiple clients that we work with that own stock and they own cash. They just say, I hate bonds, man. I hate bonds. Bonds are for losers. They always keep a lot of cash. Well, okay, so bonds are not great. They're not sexy. Bonds in March and April of this year went through the roof when the COVID hit. That was kind of nice. Treasury bonds, that is. So they can zig when stocks zag, not always, but can. But always keeping a lot of cash. Again, right now, the expected return of cash for wealth, not very good. If you have money for the next year or two, if you have emergency funds, getting back to this client number 1, it's perfectly acceptable to have what's called too much cash for me, as long as it's something that you feel good about. You have enough money for a number of years. You have enough money for emergencies. Maybe you have a car or something that you're going to buy in a year or two. Absolutely, that's not too much cash. Too much cash means when you're feeling guilty about it. That's probably the definition of that. But anyway, so again, annuities for I hate bond people, it might be something that you can do. So let's talk about the first type of annuities. These are the guarantors. Okay, these are the deferred fixed annuities. People like to say they're like CDs. Well, they sort of are like CDs. They give you certain guaranteed returns. They don't have FDIC insurance, but the annuity companies or the insurance companies do have government backing. All insurance companies will pay into a state, and if the insurance companies go bankrupt, the state will pay up to $250,000 in Tennessee. Check out your state. But who wants to go to the state, fill out all the paperwork, and hope in a time of calamity that the state's going to pay you the money? So you still want to get good life insurance companies. You want to get AA, AAA rated life insurance companies. Again, there's no free lunch. The bad insurance companies might be able to offer you higher interest rates or crediting or whatever you want to call it. So they're lower return than stocks for sure, but it's guaranteed. And who doesn't like a good guarantee? Who doesn't like knowing every day you wake up you're going to get a certain percentage? It's going to be much lower, but it's going to be a certain percentage. And I will tell you what the rates are currently. A higher returns than CDs. There's a reason for this. I'll get to it in the bad. You can take out up to 10% with most of these companies, not all. You got to read the contract or get somebody that can read the contract. But many times you can take out 10% without penalty. And we'll get to liability matching. And it just means like, when are you going to spend the money? If you're going to spend the money in the next year or two, don't put it here. If you think you might spend the money in the next year or two, don't put it here. Liability matching. Sounds impressive. Actually pretty easy to understand when I show you a timeline. So the return is about 3 to 4 times CD rates, and I really questioned if I should put this because a 4-year CD, I don't know what a 4-year CD might be paying, and most of these annuities that we're looking at are 4 years, so you can maybe X this one out. The bad, if interest rates do go up, vaccine comes out, everybody decides to get the shot. Nope, anti-vaxxers, I don't want to hook an oppositional streak, but let's just say that COVID goes away next year. It's the roaring 20s all over again. Markets go crazy. And the Fed all of a sudden says, whoa, we got inflation, and they raise interest rates. Well, whatever puny amount of return that you're getting right now, that's maybe 3 to 4 times CDs, will not seem that great if interest rates go back way up, which I'm not saying they will. So you can you can buy them each year. You can buy some now, wait and see what happens with interest rates next year. Buy another deferred annuity next year. All it is filling out paperwork. There is a real penalty. With a CD, you can break the rules of the CD most of the time, and you'll get back all your money. Not so with annuities. There is a real penalty, so make sure you understand the penalty. Again, you can take out 10%, but that's the bad. This is what we call an illiquidity premium, okay? You get nothing for free. The insurance companies, they need to make money. The reason why the insurance companies want to do these deferred fixed annuities is because you give them your money and they know that they can match their own liabilities, their own issues. They can match them, and you're not going to ask for the money back. And if you do ask for the money back, they're going to make out okay. So there is no free lunch. And the ugly here is that there's actually, maybe it's digital signature, but there's actually a contract. And who likes to sign contracts where you lock yourself into things? Nobody. So that's the ugly. So because of the good, the bad, and the ugly, you really need to define which dollars could go into annuities, number one. Number two, you need to maybe put less in than you even think, because what happens if something bad happens? Well, you might need to get at the money. And again, you can take out 10%, but don't put your life saving or all your cash into one of these things because there are rules. Okay, so indexed annuities. These are equity indexed annuities. This comes usually with a free steak dinner. We don't give a free steak dinner with it because We think it's more the sizzle than the steak, and that's the reason why people like equity indexed annuities. So we actually do think these products can be good. And it says here, fooling ourselves is good if it's for the right reason. And this is absolutely the case, that equity indexed annuities, people said, look, I want the return of stocks. And the insurance company said, okay, you want the return of stocks? And they said, yeah, but I don't want to ever lose any money. Oh, okay, you don't want to lose any money. Okay, yeah, we can do that. All right, so do you actually get the return of stocks? No. The insurance companies, they live in the same sandbox that we live in. We all live in the same world. We all have the same interest rates. They invest in the same investments that we invest in. They have a massive scale, and they have the ability to have annuity credits too, where certain people die and certain people live longer. They have all these things, but they still live in the same sandbox that we do. So when they say that when the insurance people, it's not really so much the insurance company, but the insurance people, say, look, you can get the returns of stocks, but you'll never lose money. Well, what they do is you'll never lose money, but you'll also get a lot lower return of stocks. And I've talked to a few annuity people that sell it for commission, and they always tell me, well, you don't know my insurance products. Mine are much better. Mine have participation rates of 100%. They have caps of this. And every time I've looked at these policies, you can't lose money in a year, but you're not going to get stock-like returns. There's just no way. If you want to know how these things work, you give your money to the insurance company. They buy bonds. They buy call options. And then that amount of money, they carve out some for you, and they carve out some for themselves. And if there's an annuity salesperson, they also carve out some for them. An annuity salesperson will say that you don't pay the commission, the insurance company does. And right here, the myth of free or no expense fixed or equity indexed annuities. You can go to Michael Kitz's Nerd's Eye View, and you can read about the fact that that's not really true. Now, the reason why the insurance agents can say it's true is that if you stick with the long surrender period, you end up not paying their commission. But the reason why there's such a long, we're talking like sometimes 7 to 10 year surrender period, is because they're getting paid, and the money can't just come from nowhere. So there is, engineers are about the only people that I have found that really can understand these annuities. They're really hard to, and we have multiple engineers that work with our team. They're really hard to understand. And there's no magic. There's no magic in these products. They make it sound like the insurance companies are the most brilliant people and there's magic. There's no magic. I'm sorry, there's no Santa Claus. There's no unicorns. There's no magic in annuities. Now, there's variable annuities with guaranteed income. There's indexed annuities, equity index annuities with guaranteed income. You can have all these different things. I'm not going to get into that today. What we're thinking about here, though, is like when I said fooling ourselves. Again, if you say, well, I can only get 2.75% with a deferred fixed annuity, I don't want that. And we say to you, hey, look, we have these equity indexed annuities. You might be able to get 5 in good years and never lose money. And you say, yeah, that sounds a lot better. I want to have the possibility of getting 5. Now, at the end of the time period, when we look back, it might not be much more than the same 2.75, but there is that effect with these equity indexed annuities that you do feel like you're going to get higher returns when stocks do well. And that's okay as long as you go into it with your eyes open. So the other thing with insurance is that you can get pretty much whatever you want to get. Originally people would hand their money to the life insurance company, and the life insurance company would hand it back to us over long periods of time. Those who died would lose the annuity lottery, and those who lived really long would get more money. And then people said, look, I don't want to give my money to the insurance company. And the insurance company said, we got a problem. They don't want to give us their money. How about we don't have them give us our money? We have a deferred, fixed, and then another type of immediate fixed annuity. How about we have that? And people are like, yeah, I like that better. And then people said, well, the stock market's doing really well. And the insurance company said, okay, we'll give you a variable annuity. And you have to have actually an equity license to be able to sell those products if you're selling them for commission. Variable annuity. People said, I don't like these variable annuities. They go down just like the stock market does. I want to know that I'm going to have income. So they said, all right, we'll put on these income riders. So whatever you want, they'll give you. But the problem is that the returns just get shorter and shorter, and there's not that much return right now. So you can have anything you want. It's just always going to cost you. So here's what I said about liability matching is not that hard. And what I mean by that is if you're the CFO of a company, you might want to know when you're going to buy a new building or you're going to, launch a new product or something like that. That's your job as a CFO. Make those strategic decisions, communicate with the CEO. Well, you're the CEO of your family, and all we're saying here is matching the investments with the needs. It's pretty simple. So, like in this situation right here, client doesn't really start needing retirement money until 2033. So you can, take money that's, have an emergency fund, maybe a little extra cash, a little slush money. Got some college expenses here, so hopefully that's taken care of. But we know we don't have liabilities from our investments until this time period. So it's okay to put it in equities. It's okay to put it in bonds. It's okay to, again, diversify, and it's not guaranteed. But if you can't do that, then this might be a time to use annuities. And there just are people that can't do it. I mean, that's what we've learned. So if you take nothing else away from this, take this away. There is no magic. We're all playing in the same sandbox. There's all these types of bonuses. When you sign the annuity, you get a bonus. Well, it's only for income. And the reason I'll tell you that the bonus is not really a bonus is that if you turn around and tell the insurance company, I want my money right back, they don't give you the bonus. But they'll give you income over your lifetime based on a higher number, so it makes you feel good. You cannot have higher upside with better downside protection. You just can't do it. I don't know how it could be done. Now, if you do have an insurance company that offers you the most incredible returns, let's say an insurance company comes out and you're getting 10% guaranteed returns every year, probably a scam. Probably a scam, or an insurance company that's going to go bankrupt, and then you're going to have to go get your money back from the government. So and then I do say here, it's okay to be fooled with the promise of higher upside returns with equity indexed annuities. It's okay to be fooled. Variable annuities with lifetime guaranteed benefits, again, sometimes we're probably not going to have money left if there's really high fees at the end. But it's okay to be fooled by these things as long as you know that I have the promise of maybe having higher returns, and that's why I'm able to go into this product. I'm being fooled by the promise of upside, really massively upside returns. I'll probably still do okay, and I'll get a return, and that's okay. So if you don't want the deferred fixed, sometimes the equity index will be okay. Just don't expect to get real high returns. So what's available today? Well, what I've seen recently is 2.75% in deferred fixed annuities, and they're 4-year. So these rates can change at any time. And some of the ones, you usually find the survivors, but some of the equity indexed annuities, they've had promises of 11% upside. They're not available today. That's all I can tell you. They're not available today. And that's because interest rates are so low. And so what I've been seeing is 3.8 to 5%. The products today, if we bring them back into the past with the stock markets that we've had based on certain equity indexes, that's about what you'll get somewhere, and you could even get lower than 3.8%. I'm saying that might be more on the upside, 3.8 to 5%. So, and I say here, please do not say yours is better. Sometimes insurance people will go on these videos and then attack them and say that they have better products. If you have them, great. I don't believe it. There's no free lunch. But anyway, maybe your life insurance company is offering something crazy. Anyway, I appreciate everybody watching. If you have any interest in these products, we love to talk about them. We love to talk about, like, frame them, about how they're best, and then we can get into the details or not. But we never get paid a commission, and I think at least that helps us to think through these things pretty strategically. So thanks for watching. Take care.